Hello, good evening, everyone. Okay, before we start, I think I would like to make an special announcement over here because when you register, right, by right, the presenter for today actually is the Daryl Lim from the bond dealer team. But however, he's not feeling well today. So that's why I will replace Daryl and be the presenter for today. So I'm Sean. I'm from Client Investment Specialist team. So I hope you all start to, I think the participant in Zoom actually is gathering lah. So maybe we will start in another 30 seconds or 1 minute. So at the same time, I think before we start, maybe let me share a little bit about the house rules of our FSMOne webinar. So for tonight webinar, actually, we will open up the chat box, meaning to say, for all the participants, actually, you feel free to chat among with all the participants, and then also you can also reply to my question through the chat box along the webinar. And then, but most important, one important notes for you is if you would like to ask me any question, so specifically for this particular bond seminar, I hope you can raise your question in the Q&A toolbox. Because if you put it under chat, then actually it will be flooded by other people comment, and then I'm not able to find it one by one. So I would appreciate if you is able to raise your question under the Q&A chat box. Okay, thank you very much. So I think we can start now. So very good evening to everyone. So I'm Sean from Client Investment Specialist team. So I will be the presenter for today Bond Masterclass. So hi everyone. So I think for today's section, actually we are live in the Zoom. We have the Zoom section, and then at the same time, we also have the live in the Facebook. So the friend is Facebook. If you can help us to share this particular webinar to your friend, then I will be very appreciated. So before we start the webinar, can I ask you all one question? So any one of you actually already invested in bond through FSMOne before? Can you type 1 for me? For those that actually haven't invested before in bond, maybe you type 0 for me? Hello, Bernard. Hello. Well, seems like quite a lot of people in Zoom actually you are invested in bond before. And then also some of you actually haven't invested in bond before. That's why you are here, right? Okay. So thank you for your response. So before we start, I would like to let you know what is the bond investment environment for now. So basically for bond investment, right, it is a investment that actually is available for sophisticated investor only previously, because a lot size of bond actually can cost up to 250,000, and then even it will cost more for the government bond. For example, a Malaysia government bond, it will cost as high as 5 million per lot. So previously, before our company exists, so investor, only sophisticated investor, means the rich investor or the institutional investor, they are able to invest in the bond instrument through investment bank only. So for retail investor like us, how do we access to the bond investment? Normally, we can only access to bond investment through bond fund. Meaning to say, when you want to invest in when you want to get the exposure of bond investment, you can only use unit trust fund, which is the bond fund, to get the exposure. Because when you invest in bond fund, then the fund manager will help you to invest in a various different bond, and then to help you to diversify. But today, in FSMOne, actually you do not need to pay 250,000 to buy a single lot of bond anymore, because we already got the license to have the retail bonds in our platform. So under FSMOne, we have this facility called Bond Express platform. So under Bond Express Bond Express platform, we do have two kind of bond. Number one is retail bond, and then number two will be the wholesale bond. So for retail bond, actually you can buy as low as 1,000, and wholesale bond you can buy as low as 5,000. So for how FSMOne is able to do that in a smaller lot size, how we do that is actually for our platform, our company will buy the whole lot. We still buy the whole lot, 250,000 a lot. Maybe we'll buy 2 or 3 lot, and then we will cut into small pieces and resell it back to investor. So we got the license from SC to perform the Bond Express platform. We are the first platform or first company in Malaysia to get this license. So without further ado, I will continue with my presentation. So the next slide, actually, this is the disclaimer. So for disclaimer, actually, the main objective here actually is to let you know that in my next presentation slide, if there's any bond names or any company name, actually it's not served for the recommendation purpose. So if you need any bond recommendation, feel free to ask our bond dealer team or the CIS team, the client investment specialist team. So the purpose of the presentation today is after today's presentation, I would like to let you all know why buy bond today, actually why today is the best time for you to invest in bond. So before we start, I would like to share you all with a quote. So there's no such thing as a free lunch. I think all of you should agree with this particular quote, right? But what if I tell you that actually in this world, there is a free lunch? Why I say so? If you still recall, if you can recall back during COVID-19 time, during 2020 to 2021, during that time, for US market, actually the interest rate go down very low during that time. Equals to 0%, 0.20 to 0.25%. What does this mean? 0% to 0.25% kind of interest rate. It means a free money to the market, because when you borrow the money from bank, actually you just pay a very little interest rate or even no interest rate. We borrow the money from the banks. So what during that time, right? Actually, the easy money flow over the market during that time. And then what happened when people has easy money, and what happened when people has free money? So you just imagine that if you kena lottery tonight, what will you do with the money? You will speculate, right? You will invest in Bitcoin, you will invest in property, you will invest in whatever things you will spend and whatsoever. So during that time, right, it will drive up the price of all the asset. So is this low interest rate environment good for investor or not? Is low interest rate environment good for saver or not? Actually, it's not benefit to saver or investor like us, because during that time, if you want to invest in FD, the interest rate is close to 0%. So you do not have benefit to invest or keep the money in the bank or save the money. But fast forward to today, when the interest rate rise to close to 5 or 5.25%. So there's no more free lunch in the market because the borrowing cost is very high. But during this time, actually, when borrowing cost is high, when interest rate is high, actually it's good for investor like us or saver like us. Why? Because when we save in FD or when we save or invest in bond paper, actually we will get or we are able to lock in higher yield or higher return during this time. So before we start, actually let me let you understand a very simple concept on what is the difference of stock investment versus bond investment. So let me use one company as example, which is our our Malaysia, very famous company, Malaysia Airline. So for Malaysia Airline, if you are the stock investor for Malaysia Airline, for MAS, during COVID time, during 2020, will you feel happy? No, right? Because during that time, the travel restrictions, most of the people cannot fly. All the people cannot fly. So what happened to the stock price during that time for MAS? The stock price declined, right? Dropped a lot. So for stock investor, actually, they are not happy during that time. But what if you are a bond investor for MAS, for Malaysia Airline? What happened to your investment? Your investment actually will still gain you the return because Malaysia Airlines still continue to pay the coupon payment. They still continue to pay the interest that they promised to you, be it 4.5% or 5% per annum. They still need to continue to pay you the coupon payment or the interest that they promised. Because if they do not pay you, means they are default on the paper already. So for Malaysia Airline, actually, it's backed by government. So during that time, if a Malaysia Airline is not able to generate the income to pay for the bond or the coupon payment, the government will also help them to pay because it's backed by government. So this is the difference of stock investment and bond investment, basically, because when you invest in stock, you are invested in the future growth of the company. You hope when you invest in this company, you hope the company become the next big 10 company or big 20 company in the world. So they will become the Tesla in future, or they will become Alibaba or Tencent in future when you invested in their company. You invested on the growth of the company. But when you invest in bond, actually you are looking at the present. Whether you just need to evaluate whether this company, when you borrow the money to this company, is this company able to pay back you the money or not at the end of the tenor? If you borrow money for 5 years, after 5 years, will this company able to pay back you or not? That's it. Very simple for bond investment. So for this particular slide, I would like to share with you the benchmark when we invest in fixed income fund, which means the bond. So normally, right, when people invest in bond, most investors actually, they will benchmark the bond return, or they will benchmark at least the bond return must more than FD. So FD will be one of the benchmark. Normally investor tell us, because when we share about the bond idea, customer told us, do you have anything above the FD? If you do not above the FD, don't tell me. So this is a benchmark that the investor set. But even we also encounter some of the investor, they want something higher than EPF return. Very ganas. They want something that 6 to 7% return from bond investment. We do have also 6 to 7% or even 8 or 9% investment return from bond. But of course, you need to remember the code is, if you invested in higher yield, means if you look for higher return, then you will need to prepare to absorb higher risk. So this is the very important thing that I would like to let you all know today. And then what is the best benchmark when we invested in bond paper? Inflation actually is the best benchmark. Inflation is at least the minimum thing that you will need to hit when you invested, no matter bond or other investment instrument. Inflation is the least for you to hit, because inflation will cause your money become smaller and smaller over time. So if your investment is not able to cover the inflation rate, then meaning to say actually your investment is not a good investment. So for example, the inflation for Malaysia right now currently is around 3.3%. So when you invest in bond, you need to look for the bond that is able to give you a return higher than 3.3%. So let me share about the new bond offering. So I think a lot of investors, they are curious on how the new bond being offered, because for bond investment, right, they are not like stock investment. Because for stock investment, we have a proper exchange in the market. Like for example, in Malaysia, we have Bursa Malaysia. So Bursa actually is a proper exchange. So all the investors, when you want to trade stock, you can go to Bursa and then you can place your interest. For example, if I want to buy public bank, so I can, all the people is able to place what is the price that I want to buy. Then they queue over there. And then what is the price that the seller willing to sell? So actually it's very transparent when you have the exchange. You know what is the price offered by seller, and then you know what is the price that the buyer want to buy. But for bond investment, actually it's not very transparent, because for now, bond is still trade over the counter. Over the counter means there is no exchange asset in the market. So meaning to say, when you want to buy bond, where do you buy? You will need to go through investment bank. So we have a lot of different investment bank in the market. So which means you only able to buy over the counter, over all the different investment bank by negotiation, because you won't able to get the price information like exchange. You're not able to know who is the buyer, who is the seller. You need those intermediate people, the investment bank, to tell you, oh, now I have this stock, I have this price, do you want or not? So this is over the counter trading. So it requires a lot of negotiation power, because the price is not made known to investor. So for new bond offerings, this is the four type of offering for bond right now. So for auction, normally is applicable for government bond. So government bond, as you all know, the meaning of auction is all the people will bid for the price. So whoever that able to win the bid, then actually the government bond, actually they will issue according to that particular price. So normally only government bond will be offered by auction. So the second one is the most common new bond IPO offerings, which is the book building. Book building actually is very simple kind of process. How book building works is when the company would like to raise the fund. So for example, IFAS would like to raise 100 millions. Then we will go to look for an investment bank. So the investment bank, what investment bank will do is, actually they do not know whether the participant in the market, they want to buy IFAS bond or not. So they will ask around, they'll ask, hey, Maybank, I have 100 million IFAS, do you want or not? We can offer you 6%. So if Maybank say, okay, I can buy from you 20 millions, then they will ask another investment bank, hey, Mbank, can you, I have IFAS 6%, do you want or not? So book building means they will build out the book by asking around. And then if they confirm that actually there is an interest in the market for this 100 millions bond, then they will kickstart the IPO and sell into the market. So during the book building, each of the party actually, for the lender, right, if I want to borrow money, of course I want to pay as low as interest as possible, right? But for the people that borrow the money, of course I want to earn as much as return as possible. So the process of book building actually is to find a moderate, the balance in between these two. And then they will find a balance rate, and then the bond will be offered in the market by book buildings. And then the third one, private placement. Private placement actually means the private negotiation. So normally for private placement, it will not go through public. It's just a deal in between a few people. For example, if IFAS want to issue a bond, then maybe we just find one investor or two investors. Then we want to raise 100 million. Are you okay or not? Do you want the whole bond or not? Then the particular single investor, they agree with the terms, everything. okay, 6%, I'm okay, and then I will buy 100 million from you. So this will be the under private negotiation. We call it private placement. It won't involve the retail investor or the investor out there. So it's just a deal in between a few people. So lastly, bought deal. Bought deal actually, it will also quite similar with book building, but the difference here will be the investment bank, because just now I mentioned that when the company, right, when they want to borrow money, when they want to issue a bond, they will need to go through an investment bank. So under bought deal, here is the investment bank. Actually, they are very confident that I can help you to sell off this bond. Means, okay, I promise IFAS, I will able to buy, I will able to sapu all the bond that you offer. 100 million, I sapu. So this particular investment bank, they sapu, they bought first, they buy first, they buy the deals, they buy the 100 millions. And then for IFAS, then the borrower or the bond issuer, the bond issuer will be very happy, because the purpose or the main purpose that we raise the bond actually is we want to get the money. So now the investment bank willing to give us the money, secure the borrowing first. So I'm very happy, and then I will sell off everything to the investment bank. So what investment bank do is they will resell it to investor. So normally during bond IPO, right, the pricing of bond, it will be 100, meaning to say 100%. But for the bought deal, because the investment bank bought over and resell in the market, normally they will top up a little bit. So the pricing that you saw from our website, right, during the bond IPO, if the deals is under bought deals, normally you won't see 100 bond price anymore for IPO. The investment bank, normally they will mark up a little bit. They'll mark up maybe 0.19 or 0.25 on top of 100. So you will see bought deals, normally the bond price will be 100 point something. That one is the additional markup from the investment bank. So this is how a bond being priced. Because like I shared just now, because the bond, right, actually you do not have a fixed things to price the bonds. So this is how normally the market price the bond. Actually, the whole things actually is very simple only. You just imagine this is two set of Lego, the green part and the red part. So the green part of Lego actually is the risk-free rate of return. So what are we benchmark against the risk-free rate in the bond investment? Normally in the bond investment, right, the most secured investment, it will be the government bond. So meaning to say, if IFAS today want to issue a bond, the minimum benchmark or the minimum price that we need to issue, we need to follow the government bond rate. So, okay, for example, if IFAS issue 100 million bond for 5 years, so we will need to refer to MGS, the Malaysia Government Security 5-year bonds. So if you check, okay, 5-year bond is 3.5%, meaning to say when we want to price a bond, a minimum price will be at least you need to price 3.5, because Malaysia government is selling at 3.5% for 5-year bond. So the rest of them, it will be the risk premium already, meaning to say it will depend on your company risk, whether your company is very stable company or your company is a very small company, and then the risk of repayment is there. So it would so the risk premium actually is a spread on top of the risk-free rate. So meaning to say, okay, if we issue a bond, if the company is very stable, it's the banks or maybe it's a blue chip company, maybe they just need to top additional maybe 2% on top of the risk-free rate. So meaning to say 3.5 plus 2, I just issue 5% or 5.5% bond, I'm able to attract investor already. But what if the company is very small and then never got people heard about this particular company? They need to price higher. in order to attract investor. That's why in my previous slide, when I mentioned, there's always got a bond that actually priced at maybe 7% coupon rate, or even 8 or 9% coupon rate. But the risk will be higher because only those companies that they want to attract investor, they will need to place higher risk premium in order to attract investor. So higher risk premium means those companies, it will incur higher risk in return. So when come to every investment, right, we need to understand the risk when we invested in the particular investment, for example, bond today. So what is the risk that we will need to take note? So the bigger risk is the two that I highlight here, credit risk, which we refer to default risk. And then secondly will be interest rate risk. So I will share these two with you later on. And then let me explain what is liquidity risk. Liquidity risk actually is also applicable for other investment as well. Liquidity risk means if you need the money, how fast can you withdraw the money, or how liquid the investment it is that you are able to get the money out. Because for investment that do not have liquidity, means if you need the money, you are not able to sell off, or maybe you will need to sell off at a lower price, at a very discount price. So for bond investment, right, there's always this liquidity risk. So when we pick for bond, means when we select the company to invest, then this one, the liquidity risk actually is also one of the things to consider. So how do we avoid the liquidity risk? One thing to avoid is actually you can invest in those high credit rating company. Normally, those high credit rating company, the liquidity is there, meaning to say, if you resell in the market, there's always a party to buy back the bond from you, because the bond itself actually is still attractive. So what kind of bond actually has less liquidity in the market? First thing, the bond that actually is close to default, meaning to say maybe the credit risk rating got dropped by the individual independent rating agency. So meaning to say the financial performance of the company is not that good already. So that's why the liquidity will be lesser, because no people want to buy a weak company from you. And then the secondly will be the company that already default. The company that already default, definitely no people willing to buy from you. So number 4 here is the foreign exchange exposure. So the foreign exchange risk actually refer to the forex, the currency exchange risk. So this one only applicable when you buy foreign bonds, sorry. So when you buy foreign bond, of course you will need to convert to respective currency, and then therefore the foreign exchange exposure or foreign exchange risk here, it will be kicked in, because if the MYR strengthening, then actually you will make a losses in your investment. If the MYR weakening, actually you will make some gain on the forex exchange. So let us go through on the credit or the default risk. So for the credit and default risk, this is the biggest risk when we invest in bond. Because when we invest in bond, right, it's same like when we borrow, is same as we borrow the money to the company. And then if the company is not able to pay back our money, or not able to to fulfill the obligation to pay the interest payment, or what we call it the coupon payment to investor, meaning to say actually they are default on the bond already, means they do not have strength to repay back. So once the bond default, actually the investor will lose everything. Meaning to say, if you invested 250,000 in this bond, if the company is not able to pay back you, then actually you will face a total loss on your investment. So that's why the default risk actually is the bigger risk when we invest in bond. So how do we mitigate this particular risk? So we are able to mitigate this particular risk with below these two things. So the most important thing when we invest in bond is we will need to carefully search or filter for the company that we borrow the money. So basically, it's very simple. It's just like us personally. If you want to borrow the money to our friend, right? You will need to justify. You will need to perform some checking on your friend, whether is it this fellow my friend. Do my friend, what is the occupation of my friend? Do my friend have a regular income or not? So what is the way that he earned the money from? So we will need to understand before we borrow the money to our friend, right? And then at the same time, we also need to reassess whether when you want to borrow the money to a friend, you will need to reassess whether your friend, when come to repay the payment, whether they have the cash or how they get the cash to pay back you, whether they have other asset or not. Meaning to say, you will need to see whether they have car or not, whether they have house or not. If they are not able to repay you, maybe they can sell off the asset and repay back to you. So when come to bond investment, actually it's the same thing. When you borrow the money to a friend, you have to assess the repayment abilities. Meaning to say, we have to understand the cash flow of the company. How do they generate the return? It is a general return from the daily operation. And then also we need to understand what is the percentage of borrowing in the company. So because if the company borrow a lot, meaning to say they will need more money to repay back all this borrowing. So, and then also the borrowing and also the commitment, meaning to say the commitment, when the commitment is very high, then actually the repayment abilities for the company will become lower. Means it's not that good anymore. Because and then another thing that under the repayment ability that we will need to take note is, because for the listed company, when they want to issue a bond, right, they are not necessarily only issue one bond. Some company, they might have bond 1, bond 2, bond 3, bond 4, bond 5. They have different tranches of bond, which will be matured in different timeline. So for repayment ability, we will need to take note, we will need to check the company, whether this particular company, will they have any bond going to mature in the next 6 months, in the next 1 year, or the next 2 years. So if they does, then we will need to check whether, because the bond actually, the bond amount actually is quite huge, meaning to say they will borrow 200 million, 300 million, or 100 million. So when come to maturity, the company will need to pay back the principal. So we need to check whether the company, where can they pay the money from? Meaning to say, if we notice that the company, they will have 1 or 2 bond going to mature, then we will need to understand where can they generate this money to pay off the loan. And then secondly, refinancing ability. Normally for the bond issuer, how do they repay back the principal? Normally, most of the market practice is they will issue a new bond. They will issue a new bond, and then they get the money from the new bond and pay back the existing bond. So this is, we call it refinancing ability. So most of the company actually, like the Apong Kamkwa. So they will take one bond to cover another bonds. But actually this is normal in the finance or normal in the financing market. So we have to recheck the refinancing abilities. We have to check whether this company, whether they have any asset or not. And then we have to check whether they can borrow further or not. Because sometimes if the company have too much borrowing, then actually the bank won't allow them to borrow the money anymore. And then it will be the same when come back to the bond market. Because if your repayment abilities is very low, then actually the banker itself, means the investment bank, they are unlikely to help you to issue a new bond anymore because you have the difficulty to pay back the existing bond. So refinancing ability is also one of the things that we need to consider when we invest in the company. The other risk will be the interest rate risk. Okay, this one I think is a little bit complicated. I will explain in more layman way lah. So for bond, when it comes to bond investment, right, interest rate is one of the key things that we will need to take note. That's why you will notice that interest rate risk actually is ranked the second risk under my previous slide. So interest rate normally will have a reverse relationship with bond price. So meaning to say when interest rate go up, the bond price will go down. So the pricing, just like I mentioned, the bond price, the pricing is 100, meaning 100%. So if interest rate go up, let me explain the concept first. So why interest rate go up, the price will fall? Because just imagine if you hold a 5% bond today. So if you hold a 5% bond, tomorrow government announce, I would like to raise interest rate to 6%. So if government rise the interest rate to 6%, the interest rate go up. What does interest rate go up means? When interest rate go up, meaning to say your FD will go up. Your FD rate will also go up. And then at the same time, the new bond that we're going to issue after the interest rate rise, can they issue at 5%? No, because people won't buy your 5% anymore. They have to issue at 6% or even higher, 7%, in order to attract new investor. So at the same time, what happened to your 5% bond? People will sell off your 5% bond, right? They will sell off your bond and go to buy a new bond, or they will sell off your bond and go to place in FD because interest rate is higher than your bond. So that's when people sell off your bond, then which means your price will drop, right? Your price will drop from 100 to maybe 95, 94, 93, whatever price that it will give you the yield. So when your price drop, it will affect your yield. Yield means the return, your annualized return in the bond investment, means the average return per year. So why bond price fall, the yield will rise? Because the concept of bond is when you buy the bond and hold to maturity, the company will pay back you. Okay, for example, if the price fall to 95 and I buy I buy this 5% bond at $95. So what I will receive from the company will be, the company will pay me 5% every year. They will still pay me 5% coupon rate every year for the next 5 years. And then when come to maturity, how much will I receive? The company will pay back me 95 or will pay back me 100. The company will definitely pay back me 100, the principal. So from here, right, I will earn a capital appreciation from 95 to 100, which means additional 5%, because the price fall and that's why the yield will rise. Because when I buy cheaper, then I will get the capital appreciation here. So when we add up the capital appreciation on top of my coupon payment, means my annualized return, my average return will be higher. So this is a relationship of the interest rate environment. And then alternatively, vice versa, if the interest rate fall, if the interest rate go down, the bond price is reversed, right? The bond price will go up. Because when we use back the same example, if you have 5%, you're holding 5% bond today, and government tomorrow announce interest rate drop to 3%. So will your 5% bond become attractive? Definitely yes, definitely right. Because when you place in FD, you get 3%. only. But if people come to buy your bond, they will get 5% return. So when a lot of people come and buy your bond price will increase because supply and demand, right? The bond price will go up. So when your bond prices go up, because normally your bond is priced 100. So when your bond price go up, 101, 102, 103, 105. So when the bond go up, the yield, when the bond price go up, the yield will fall. Why the average return will fall? Because when you buy the higher bond price, meaning to say you are paying premium. You are buying, okay, if I buy in 105, actually I'm paying additional 5% to buy this particular bond. Of course, I will receive 5% per year for the next 5 years. But at the end of the day, the company will still pay back me 100, right? So meaning to say I pay additional 5% premium to buy a 100, the bond that price in 100. So that's why the average return of my investment actually fall. So this is the relationship. What will happen when interest rate go up and interest rate go down? So in the previous slide, in the beginning of slide, actually I mentioned that I would like to let you all know why today is the best time to buy bond because of this. Because if you're looking at the interest rate environment now, the interest rate environment in US market actually is almost peak already. The most, maybe the Federal will raise another 1 or 2 times interest rate. So we can say currently 5.25% actually is almost peak interest rate environment. So this interest rate risk, right, it will affect on 2 segments. So if you are existing investor, means I'm the existing investor, I already hold the bond. So when interest rate go up, I suffer losses because the bond price drop, right? So in my portfolio, I will see my bond price no more 100. My bond price drop to 95. So I suffer the bond price losses if I am the existing investor. But what if I tell you the interest rate risk can be mitigated? How do we mitigate the interest rate risk? We mitigate the interest rate risk by hold the bond to maturity. Just like I mentioned already, right? If you hold the bond to maturity, then actually interest rate movement, no matter how high or how low the interest rate go, it doesn't matter to you because at the end of the day, when you hold to maturity, the company will pay back you 100. So no matter the bond price drop to 95, 90 or whatever price, if you hold to maturity, the company will pay back you 100. So if you hold to maturity, if you have long enough investment tenor, you are able to absorb this interest rate risk. And then what if you are the new investor, meaning to say I never invest in bond before. I want to start invest in bond now. So if during this time, when the interest rate environment is very high, is under high interest rate environment, are you benefit? Yes, definitely. Why? Because you are buying when the bond price drop. Because interest rate go up, the bond price drop. So when interest rate go to almost the peak, means the bond price drop almost the lowest pricing already. So if you buy right now, if you are a new investor, you buy right now, you enjoy higher yield. Meaning to say you lock in. You lock in your higher yield right now, your higher return right now. Because once you buy the bond, once you lock in the price, then actually the bond actually it will able to give you a fixed return already. Because okay, for example, if I buy the price in $95, will my price change in future? No, because once I lock in 95, I already know that I will earn 5% capital appreciation for sure. Because at the end of the day, company will sure pay back me 100 unless the company default. So I will be sure that I will receive 5% coupon rate every year. That one also is sure already. Meaning to say you are able to lock in the price right now. So What if you think further? When interest rate fall, what happened when interest rate fall? If you lock in the higher rate right now, and then in the next cycle, in the next interest rate cycle, when interest rate fall, when interest rate go down, what happened to your bond price? Your bond price will go up, right? Maybe from 95, 96, 97, even you can cross 100. It can be 100, 01, 02, 03, or whatsoever. So you can enjoy additional capital appreciation from there if the interest rate environment overturn, because if interest rate fall, the bond price will go up. So meaning to say, if you do not, for those investors that actually you do not want to hold to maturity, you think, oh, next 5 years actually is very long, or next 7 years, some bond actually they have a very long tenor. The next 7 years actually is very long. I do not want to hold to maturity. Then actually you can take the advantage of this current environment, because if the interest rate overturn, so investor will ask me, when will the interest rate fall? Normally the interest rate, the factor that affect the decision on the interest rate go up or go down, actually it will depend on the market condition. Meaning to say, normally government, if you still can recall, during which period our interest rate fall to very bottom in Malaysia. If you still can recall, during COVID time, right? During COVID time, when a lot of people do not have job, when a lot of factory is closed. So during that time, because of government, they were worried about the recession. They were worried about the condition of the market. When they want to spur the spending, when they want to increase the money flow in the market, at the time, the government will cut the interest rate. You still remember during that time, the interest rate cut to as low as, I think the FD as low as 2% or 1 point something percent rate. So if during this time, when interest rate go very high, and then when US fall into recessions, and then it will affect other country, then during this time, in the interest rate policy might overturn, because when a lot of people do not have job, when a lot of people is suffering, then the interest rate policy will change. Government will cut down interest rate. So during that time, then the bond price will be benefit. For existing investor that you already locked in, your bond price will go up. So this is the concept that I would like to let you know, let you all know. When you invest in bond, this is one of the important thing that you can take advantage to. Okay, let's go for the Q&A section. So which type of bond will have the highest interest rate risk? So after the very long explanation, so I would like to know what is your understanding about the interest rate risk. So you can answer in the chat. So A is investment grade bond, B will be high investment grade bond, C will be higher bond, D will be distressed bond. So you can answer, and then let me have a drink first. Okay, let me see the answer. I think a lot of people answer D, distressed bond and higher bond. Okay, I think none of you get it correct. The correct answer actually is high investment grade bond. Okay, I think a lot of people answer higher bond and distressed bond. Maybe let me explain what is higher bond. Higher bond means those company that actually they need to how to say, they need to incur higher coupon payment in order to attract investor. Meaning to say, those bond that actually they do not have very high credit rating bond. So that's why they are offering high coupon payment to investor. We call it higher bond. And then D will be distressed bond. Distressed bond means those bond that already going to default or already default. Why is not these two? It's not C and D. Because if you invest in higher bond, or when your bond actually is already distressed, just now I mentioned there's two risks, right? Interest rate risk and credit risk. So for C and D, right, investor will not care about their interest rate risk anymore. Because for them, for investor, for me itself, if for those higher bond and distressed bond, I will like to popi, they can pay back my investment, they can pay back my money, right? That's the bigger risk incurred when I invested in those bonds. So that's why interest rate is not important anymore, because most importantly will be the company can pay back me the money or not. So that's why C and D will not incur to the interest rate risk. So for A and B, right, they will incur more on interest rate risk. They are more sensitive to interest rate movement, especially for high investment grade bond. Normally, high investment grade bond is referring to those high credit rating company, those blue chip company, banks, or government bond. So for this kind of company, right, they are very sensitive to interest rate environment because they have least credit risk. They are very unlikely to be default. That's why they are very they will be very sensitive to the interest rate risk. Let me further explain why is it so. So which bond actually decline the most when interest rate go up? Let me share with you a very extreme example over here. If you can see over here, I'm not too sure whether it's too small or not. So this is an Austrian government bond. The Austrian government bond that offer is Austrian century bond. Century means 100 years. So actually the tenor is very long. You borrow the money to Austrian government, the tenor is 100 years. And then you can refer to here, RAGB at the top left-hand side, 0.85%. So 0.85% actually means their coupon payment when they issue the bond. So why those people so stupid? The government only offers 0.85 only. Why so many people go to buy this particular bond? Because during that time when the government issued the bond, you can see over here, the years is around COVID-19, 2020. During that time in Austrian, actually the interest rate environment actually is the negative interest rate environment, means the interest rate is negative. What is the concept of interest rate negative? Meaning to say, if you put your money in bank, means normally when we put money in FD, we will get some return. But during in negative interest rate environment, when you put money in bank, you have to pay bank for administration fee. This is the meaning of negative interest rate environment. So during that time, during negative interest rate environment, when the government issued 0.85 return, is it a lot of people will buy? Definitely, right? You can see from the bond price. You see the bond price from 100 go all the way to 40, go all the way to 140, the bond price, because and the bond price go as high as 40%. So this one actually is a very extreme example. So to let you know that actually for bond investment, right, is also very high risk if you do not understand the concept. So when you invested in this kind of bond, government bond, and you think government bond is very secure, but in fact it's not, because if it will highly sensitive or reflect to the interest rate policy or interest rate environment. You can see from this chart. So when the policy overturn, when interest rate policy overturn, when government start to increase interest rate after December 2020, so you will notice that actually the bond price dropped all the way. From 140 to 40. So when this bond price dropped all the way, how much the bond investors suffer? They suffer 71% losses. They suffer 71% losses when they invest in government bond. So actually, this is very extreme example to let you know that actually when you invested in bond, you need to understand how the interest rate environment associate with the investment. Not necessarily government bond actually is very secure because you will encounter or you will experience a very big price, you will experience a very price appreciation or price losses when you come to this investment. So what do we need to take note from this example? Interest rate risk actually very highly associated with coupon rate and duration. Number one, coupon rate. Coupon rate, whether coupon rate high or coupon rate low, will be less sensitive to interest rate environment. Normally, for high coupon rate bond, means if you offer higher coupon rate, you will offer 7%, 8% coupon rate, you will be less sensitive with the interest rate movement. Because when you offer higher coupon rate, interest rate movement, it will be around 3-4%. So when interest rate go up, it would affect your 7 to 8%. Your 7 to 8% is still very attractive in the market, no matter interest rate up or down. But if your interest rate is very low, for example, the extreme example over here, they offer 0.85 only. So what if the interest rate, government start to raise interest rate 0.25, 0.25, 0.25, 0.5. So when the government raise the interest rate over the 0.85, means when the interest rate become 1%, become 1.5, become 2%, your bond 0.8%, 0.85% bond were not attractive anymore. So that's why for coupon rate, very low coupon rate kind of bond, it will very sensitive to interest rate movement. So this one you have to remember. High coupon rate, less sensitive. And then the other one will be the duration. Duration, short or long. So for previous example, right, century bond, 100 year. So the longer the duration, the higher volatility towards the interest rate movement. Meaning to say, if the interest rate policy is benefit to the bond, actually the price will go up very fast. Means the magnitude is quite a lot, 40%. But when the interest rate overturn, not benefit to the bond anymore, then you will see the magnitude of drop actually is 71%, very high. So the longer the duration, the more sensitive towards the interest rate environment. This is the two things that you will need to take note when invest in bond. Okay, and then the next question. A lot of people, right, when they access to our website, they will notice that some of the bond price actually is very low. Because the normal bond price when the bond being issued is 100. So when you see a very low bond price, a lot of people, it's very hard for them to justify whether how low is low. Is it the bond drop to 95 is low, or bond drop to 98 is low, or bond drop to 70 is low? So how do we justify the bond price? Because normally, why bond price will drop? Normally, bond price will drop when the bond got any negative news. So if the bond got any negative news, investor will sell off, like I said just now, supply and demand. So if investors sell off the bond, meaning to say the bond price will keep dropping. So now the question here is, the bond price now is very low. Is it something wrong with the company? A, agree. B, disagree. C, it depends. Let me see, you can answer in the chat box. I see quite a lot of people say it depends, and then some people agree. Okay. So let me explain to you. Actually, it will be depends. It depends on the company. Let me show you one example. Not necessarily every time when bond price drop, which means the company is going to default. Let me show you one example. So, okay, for this particular bond, right, this is the government bond, because when you see the bond name here, This GOVT is referred to government. If corporate is CORP. So this is the Malaysia Wakala Sukuk Berhad. The bond is issued by Malaysia government. It's a 3.075% bond. So, and it will mature in 2051. It will mature in the next 28 years or 30 years. And then this particular bond actually is issued in USD. Okay, this is how we read the bond name lah. At the front one actually is the company name or the issuer name, and then this one will be the coupon rate. Meaning to say 3.075 is the coupon rate that the Malaysia government will pay to you yearly, no matter how high or how low is the price going. They will still pay you 3.075. And then this one will be the maturity period. And then this one refer to government or corporate. And then this one refer to the currency. So why, if we refer to the price over here, the ask price is 78 only. What happened to this government? Is a bond issued by Malaysia government. So why the bond price dropped to 78? Is it government got issue? No, right? Malaysia government is still okay, but despite our currency exchange drop a lot, but Malaysia government still okay. But why the bond price of this particular bond dropped to 78.6 only? It represents around 22% drop in bond price. Because one thing to note, this bond is issued in USD. What is US interest rate right now? 5.25%, right? So if you compare to this 3.075, is this bond attractive? No, right? That's why people will sell off this bond and go for other USD bond that yield higher, that give you higher return. So that's why the bond price drop. So which means the bond price, sometimes when bond price drop, doesn't mean that the issuer got problem. Sometimes it's mainly just because of the interest rate risk. The interest rate environment is not favorable for this particular bond. So this is how we justify. We have to see the currency, and then we have to link with what is the current rate for USD. So if Malaysia MYR, we link back what is the current rate for MYR, then we will understand why the bond price dropped. And then another big thing that I need to teach you is this contingent convertible bond. In the industry, we call it COCO bond. So what does COCO bond means? I think if I give you one example, then you should know already. You know Credit Suisse, right? Sorry, you know Credit Suisse, right? So when Credit Suisse take over by UBS, the Swiss government actually decide to write off one particular bond. We call it AT1 bond, additional tier 1 bond. So this additional tier 1 bond actually is, we call it in the market, we call it COCO bond. So let me explain to you what is COCO bond and how can you identify what is COCO bond. Okay, let me show this as an example. Barclays Banks. So this is a bank. Barclays Bank actually is the, I think, second largest bank in UK. So for a bank, a Barclays Bank, you will notice that the coupon rate that the bank issue actually is very high, right? 8.3%. Even you place the FD right now, actually is just around 4%. But a bank give you 8.3% kind of coupon rate is pretty high, right? But if you just mainly based on the coupon rate to buy into the bond, then you will be in trouble if anything happened to the bond. So how do we justify, or how do we identify this particular bond is a COCO bond? First thing first, for the bank bond, if they issue under perpetual, meaning to say when they issue under perpetual means there's no maturity period, means the bond will continue ongoing until never end, means forever. They will borrow your money forever. This is called perpetual. So for perpetual, no worry, you won't borrow the money and the company won't pay back you one. Because for all the perpetual bond, normally there will be a reset date. The reset date normally is every 5 years. So every 5 years, the company will decide whether they want to redeem back the bond or not. If not, then actually they will continue the bond. So meaning to say for perpetual bond, you do not have a fixed maturity date, unlike other bond. Other bond, when they tell you that, okay, 2023 October is the maturity date, by hook or by crook, they have to pay back you on that day. But for perpetual, it's different. Perpetual, the company that issue the bond, they have the power to decide whether they want to redeem back the bond or not. So this is called perpetual. So normally for COCO bond is the bond that issued by banks. Normally it's by bank only. Issued by bank, and then it's under perpetual. So for this reset, right, no worry, because if you refer to here, the reference rate, okay, for example, if this bond, actually this will be the 5th year, they will reset at 15 December 2027. So when they reset, actually they won't pay back you the same interest rate anymore, 8.3. They will base on the latest reset rate, which is the 5-year. This one actually refer to UK bank, UK government bond, like what I explained to you, how the bond being priced. The benchmark will be the government bond. So they will refer to 5-year government bond plus the margin. The margin is very high, 5.641%. Means if the government bond during that time is 5%, they will plus another 5.6%, the risk premium. And this will be your new coupon payment when they reset. So another thing to take note for the COCO bond is the bond will have this feature, loss absorption feature. Loss absorption feature means if anything happened to the bank, you are the one to be sacrificed. Meaning to say the bank can write off your bond, but the bank won't go into default. Normally when the issuer or the bond issuer, when they are not able to pay you the coupon payment, or when they are not able to pay back you the principal, the company will become default, right? But if the bank has this bond feature, loss absorption feature, the bank won't go into bankrupt, because you have this loss absorption feature inside the contract. So that's why don't be spurred by, because of this, the bank offer you 8.3%. Is the bank stupid? No, because there's always something at the back that you will need to find out. So that's why when one thing to note is when we invest in bond paper, when we think that the coupon rate or the yield offer actually is very high, unusual high, then we have to be careful and rethink or find out, or maybe call us and understand why the bank offer such a high return, 8.3%. There will be normally there will be something behind that you will need to take note, some risk that you will need to take in order for you to earn such a high return. So, and then another thing for you to identify whether the bank bond is COCO bond or not, you can refer to the credit rating. Issuer credit rating means the credit rating of the bank, the Barclays Bank. Bond credit rating means the bond, this particular bond, this COCO bond credit rating. You will notice that the rating won't be the same, because this issuer, the Barclays, is a bank, right? So the credit rating very high, is an A grade. But this particular bond, the credit rating is BBB minus. Means the rating actually is different. They have some gap. Normally, when you see this, right, there is some gap. Normally, if the issuer credit rating is A, the bond credit rating automatically will be A. But if you see something unusual like this, means actually this is a COCO bond. Okay, let me explain about the seniority or priority when it comes to repayment. So on the right hand side, right, on the right hand side is all the rate, the credit rating of all the independent rating agency. in Malaysia or out of Malaysia. This is how they rate a bond. So you will notice that normally those investment grade bond, the premium or high investment grade bond, they will be rate A and above, A, double A, triple A. And then other than that, the non-investment grade, actually it will be BB and CCC and the junk bond. So it will be separate like this. This will be the rating. You can always refer back to our website. We will have this particular list as well. So the seniority, what if the company go bankrupt? When the company go bankrupt, this on the left hand side, this chart will be the repayment seniority. Meaning to say, you will need to understand your bond actually is under first lien or secured, senior unsecured, or senior subordinated. So this will be the priority of repayment when company go into default. So you will notice that the lowest priority will be equity. Equity means the shareholder. When you buy the share of the company, you will be the last to pay back. Means when the company go bankrupt, and then when the creditor liquidate the company, they sell off the company, they sell off the asset, they sell off the machinery, and then they get back some money. They will pay back creditor first. After they pay back creditor, they will pay back the bond, first lien bond, secured bond. Then until here, maybe don't have any money already. So they were able, only the first few able to get back the money. And then equity will be the last. So just now I mentioned the API one, the COCO bond, actually is fall under this category, junior subordinated bond. So it's the last second categories. So, okay. So now if we refer to this particular slide, right, why banks actually they need to have this API bond, additional tier 1 bond, which means the COCO bond that I explained previously. Because back in 2008, during the financial crisis, during that time, right, actually a lot of banks going bankrupt. You still remember Raymond Brothers and then Marine Banks. A lot of banks actually bankrupt because of the subprime crisis. So after this financial crisis, actually all the banks in the world, actually they innovate these particular additional tier 1 bonds in order to support the banks during that time. So for banks, right, actually they will need to fulfill a certain percentage of the equity buffer for their, we call that capital ratio, if I'm not mistaken, the capital ratio. They will need to fulfill certain percentage of capital ratio when they operate a banks. So during that time, the capital ratio will fall. So in order for the banks to recover from that, from there, what the bank can do is actually they can offset the additional tier 1. They can offset the additional tier 1 bond, like over here. They can offset the additional tier 1 bond, and then after that, it will reduce the liability of the banks, and then it will indirectly help them to able to operate, continue to operate. So this is the purpose why they want to insert the additional tier 1 bond here. In between the equity, CET1 actually is the equity, the shareholder. So additional tier 1 bond will have the loss absorption feature. This is only applicable for banking bonds only. So for this additional tier 1 bond, in normal time, it won't trigger. Normally, it won't trigger because for banks itself, the capital ratio, especially for local bank, actually is at least 2 or 3 times above the threshold. For example, if the threshold is maybe 7% or 6%, the minimum threshold of the capital ratio the bank need to maintain, most of the bank at least double. They have double digit or even 20 something percent, 18, 19 or 20% kind of capital reserve in the banks itself. So normally in good time, it's very hard for bank to trigger this this particular ratio lah, and then and trigger the loss absorption feature. But what happened in the banks in Credit Suisse actually is different issue, because that one is they have some scandal happen around under the Credit Suisse, and cause a lot of people actually sell off their investment and take out the money from Credit Suisse, because they do not comfortable on the management of the company. So therefore, it trigger the Credit Suisse takeover by the UBS. So okay, why does company want to issue perpetual bond? Do you know? Because just now I mentioned that bond actually you normally bond will have a maturity date, and then why some company they want to issue perpetual bond? Actually, there's a reason for them to issue perpetual bond. One thing is actually the company have more flexibility to manage their repayment capability. Because some company, right, when they borrow the money, actually they feel comfortable, they are okay to continue to pay you the interest rate, because the interest rate maybe is just 5% or maybe it's just 6% of the total amount only. They are okay to pay. They are okay to pay 5% for you every month when they borrow the money from you. But sometimes it's very difficult for the company to pay back the whole principal, because the principal normally is higher, like 100 million, 200 million, or 500 million kind of loan amount. So sometimes companies do not have the capability to pay back the principal. So that's why some company they prefer to issue perpetual bond. But normally normally the condition, the term and condition under the bond, it will not just benefit to the company only. It will be quite fair one, because sometimes, right, for the company when they issue perpetual bond, there will be always an incentive for them to redeem back the bond, because you will see like previous example, there will be a reset rate. Normally the reset rate actually is higher, meaning to say that if the company would like to continue, they do not want to redeem, they want to continue to pay you the bond, continue the bond for the next 5 years, they have to pay higher coupon rate to you. So that one actually, what we call that is the incentive, means if they redeem back the bond, they are not necessary, they can issue a new bond with a new rate to continue with their borrowing. So that's why sometimes the reference rate here, the reset rate, actually is one of the incentive for them to redeem back. Means if they redeem the bond, is more benefit to them. So another reason why the company want to issue perpetual bond is because of this. I'm not too sure whether there's any accountant here, but under accounting calculation, right, because perpetual do not have any maturity date. So means actually this is forever things. So for forever things, under this concept, the perpetual bond concept, by right, perpetual bond is the liability of the company. It will be need to put under maybe borrowing, under long-term liability or current liabilities. But perpetual bond under accounting treatment, because of the feature, they are very long-term, do not have maturity date. They are putting under the equity portion. So meaning to say, if you see the balance sheet, if you do not understand the concept and you see the balance sheet, actually it will beautify the balance sheet, because your borrowing will be lesser, because 660 million actually is put under here instead of put under the borrowing here. So means your borrowing will be lesser. But no worry, for our bond research team, when we analyze the company, because we understand the trick, so normally we will add back the perpetual bond, we will add back to their borrowing. So sometimes company, when they issue a perpetual bond, is because of they want to beautify their auditor report, so that it show the ratio, it will be more attractive when they show to investor. So that's a very interesting quote over here. If you own bank 100, that's your problem. But if you own the bank 100 millions, that's the bank problem. Very interesting, right? So meaning you say if you own the bank or whatsoever people a lot of money, means actually you are too big to fail already. Then they become bank problem instead of your problem. So when come to bond investment, right? I hope you all won't encounter this problem, won't encounter any bond default, because actually it's a very painful experience. But I will still need to let you know first to alert you. So what will happen when the bond go into default? Means the company not able to pay the coupon payment or not able to pay the principal. What will happen? So this will be two things will happen. There will be a debt restructurings to restructure the bond. And then secondly, if the debt restructuring is not working, then the company will go into bankrupt or go into liquidation, meaning to say they will close down the company and we have to sell off the asset and then liquidate the company. And then whatever the money that get back from the liquidation, then it will be paid back to investor. So under debt restructuring, there's two things normally the company will use. First one will be haircut. Haircut means okay, if the company borrow 100 millions from all the investor, but now the company fall into trouble, they do not have capability to pay back the loan anymore. So they will call for a meeting to ask all the investors sit down and discuss how can they restructure the debts. For example, the original debts is 100 millions, 5% for 5 years. So they will discuss and then negotiate and see how much haircut need to apply. So in the past history, actually the haircut can go as high as very high. For example, like AirAsia X, the haircut of the bond actually can be as high as they only pay back. They borrow 100 from investor, they only pay back 50 cents, 0.5%. So means the haircut is 99.5%. So this is some kind of debt restructuring process. They will have a haircut, meaning to say 100 million, I cannot pay you. What if I can only pay you 10 millions or 20 millions? That's 80% of haircut. And then they will restructure the debts in 5 years. I'm not able to pay you. I'm able to pay you in next 10 years. So they prolong the tenors and then they fix a coupon rate and then pay back you. And then one thing to note is debt restructuring means once you successful done debt restructuring, the company agree to pay you maybe 3% for next 10 years. But not necessarily everything is solved already, because it will still depend on the company whether they are able to overturn their difficulty or not. They are able to increase their operation income or not in order to pay back you the 3% every year. If after that, there's always a case that after the debt restructuring deal done, but the company also not able to generate enough income to repay back the debt restructuring. That's also will happen. And then the other one will be debt to equity swap. So debt to equity swap means very simple. Your bonds, I cannot pay back you already. I convert to my company equity, means convert to the company share. Or maybe they haircut the debts and then convert certain portion into equity. But don't be too happy, because if the company have difficulty to pay back the debts, at the same time, the equity price, mean the share price will also very ugly already. They drop a lot also already. So that's why even they convert to the equity stock for you, actually is also worth nothing during that time. So let me show you a real case scenario. This real case scenario of how difficulty of a debt restructuring. So for this Century Sunshine Holdings, actually is the fertilizer company. So this particular fertilizer company, very funny. You can see there's 4 countries over here, right? Okay, so this particular fertilizer company, actually they are incorporated in British Virgin Island. They register the company there, and then they listed in Hong Kong. They listed the company in Hong Kong. The operation of the company is in mainland China. They operate in China. And then they issue the bond in Singapore. So there is a 4 jurisdiction to fulfill when the bond go default. So when the bond go default, this particular company, they have to fulfill all the 4 Hong Kong, British Virgin Islands, China, and also Singapore law in order for them to restructure the debts. So they have to pass to the court in Singapore. So all the debt restructuring agreement have to pass for all 4 jurisdiction. So it's very messy. So until now, the Century Sunshine Group debt restructuring is still ongoing. So this is a very difficult kind of situation. Okay, let me show you this yield curve. So the yield curve that you saw right now actually is the Malaysian government bond. So as I mentioned just now, you're able to refer here that this is the benchmark of the government bond. The benchmark of the government bond for 3 years now is 3.3, 5 years 3.4, 7 years 3.6, 10 years is 3.7, and then 30 years is around 4.2. So actually the curve or the graph here actually is normal, right? It's on the outward basis. Why? Because actually it's very logic lah. If you borrow the money for longer term, of course you will charge higher interest, right? So this graph actually is very normal. So if you refer to this particular chart, this particular graph for US interest rate, so it's very unusual, right? It's very abnormal. So you will notice that for US yield curve, the yield in the 1 month to 4 months actually is very high, especially 4 months. And then after that, the bond yield drop accordingly and go up a little bit on the long-term years. So how do we read this particular chart? How do we read this? Let me cut into half from 10 years onwards. So if you cut into half, right, when we looking at here, 15 years, 20 years, 25 years, 30 years, why the interest rate for the short term is very high, 5%? Why got people so stupid still invested here? Invested for 15 years US Treasury bond. Invest in 20 or 30 years US Treasury bond, which yield lower than short term. Why? Because there's always a long-term investor in the market. For example, like retirement fund, our KWSP, or maybe the retirement fund for Tentera or whatsoever. So for this kind of fund, retirement fund, they need to plan for long term. So they need to plan and make the money for their investor for longer term because they are retirement funds. So that's why for longer terms government bond, there are still investors, especially those retirement funds, who buy it because they want to seek for stable return for the retiree. But if you refer to here, the short-term one, actually the short-term interest rate here, it will always refer the view of the market on the future interest rate movement. So if the the investor actually they foresee that actually in the next few months, the US Federal going to increase the interest rate. That's why people reflect the yield here. They sell off. They sell off because when interest rate go up, bond price will drop. So that's why they sell off. They sell off and cause the yield go up in the short term. But why the long term, over the 1 year, 2 year, 3 years actually drop? Because on the market's view or market's perspective, the interest rate is almost peaked already. And then going forward in the next 1 or 2 years, definitely interest rate the policy will be going down. So that's why it reflects in the short-term yield curve in US. So this yield curve actually is unusual, very unusual, because normally when you borrow the money, the shorter term should be lower return. The longer term should be higher return. So what does this yield curve means? The yield curve inversion here means, let me show you another table. This table actually means the US Treasury yield for 1 year versus 10 years. 1 year versus 10 years. So what does this graph mean? 1 year versus 10 years, if the graph actually is above 100, actually is the normal graph. Meaning to say, the 10 years actually is the 10 years government bond actually is more expensive than 1 year's, means year higher return than 1 year government bond. But when the chart negative, when the chart during zero means actually the movement over here actually is normal. Means actually the 10 years government bond is year higher than 1 year government bond. But when the chart go below zero, means actually unusual already, because 1 year actually it generate more return than 10 years government bond. So what does this chart show us is, currently, if we generate how up to here, actually they are negative 1.26%. So means the difference of the 1 and 10 years bond of US government, actually there's a difference of 1.26%. What does this 1.26% means? Normally, people, investors will use this to predict the recession for US market. So the probability of recession during this 126 is around here. It's around 60% that the recession will kick in if the yield curve reverse at this particular stage. So in this chart actually also tell you that going forward, if the interest rate policy going on in US market, actually the recession probability actually it will be very high. So when the US fall under recession, that's where and then the interest rate policy will overturn. Meaning to say the high interest rate policy will end, and the government, the federal, will start to cut interest rate during recession. So okay, I think I have finished most of my content that I would like to deliver to you. So okay, this is the feature bond, one of the function in our website. When you go in our website, the bond landing page, you will see this feature bond. So for this feature bond, right, actually it's a feature that the bond dealer team, actually they will place the recommended bond under feature bond. And then under this feature bond, there's an arrow for you to scroll through that not necessarily only MYR bond. They will have maybe other currency bond in US, in AUD, or maybe in SGD, in Singapore dollar. So this is an example that I captured from feature bond today. We have Tanjong, we have Genting, and then we have CIMB. So from this particular chart, right, if you refer to here, this will be the bond name, the company name, Tanjong, and then they are offering 5.76% coupon payment, meaning to say once you buy this bond, you will receive 5.76% return every year. And then until the bond will mature in 2026 June. And then this is a corporate bond, and then this is under Malaysian ringgit. And then what does life as year means here? 5.4%. The 5.4% actually means after deduct all the fee. This is a net off fee already. It means after deduct our processing fee, after deduct our bond platform fee, this is the net return that you will get, 5.4% per annum for the next 3 years until 2026. And then the live ask price is 100.19 because Tanjong actually is the quite new bond, just being IPO, That's why you will notice that this price, right? This Tanjong actually is under bought deal. Bought deal that I explained previously, the investment bank bought everything and resell to the market. That's why you see there's a 0.19% additional. They charge additional markup when they issue the bond IPO. So this will be the Genting, and then this will be for CIMB. So what you can do from the feature bond is actually we do our research team do have the article to explain or to give you some insight of this company. And then what you can do is actually you can click read idea to access to the research article piece that on that particular company before you buy into the bond. And then this is our Bond Express trading page. So for Bond Express, right, we do have retail bond and wholesale bond. Like I mentioned before, retail bond 1,000, wholesale bond 5,000. So over here, the live ask volume, actually, it means that how many stock that we have currently. 800,000 means we have 800,000 principal, the principal amount for this particular bond. Meaning to say you are able to buy up to 800,000, or you can buy up to 230,000 for this particular bond. So for Bond Express trading, it's very simple. It's operate 24 hours, past 6 days, past 7 days non-stop. You can buy anytime, even at night. So once you place order, because it's listed under our platform, once you place order, immediately, once you complete the buy order, immediately the bond holding will appear in your holding table already. And then we do have foreign currency bond, USD, SGD, or other currency bond under wholesale bond. And then this will be just now this is the bond that I capture from the feature bond. So for feature bond, actually beside these two Genting and Tanjong that we offer under MYR, we do have other maybe bank bonds offered in USD. And then also this is one of the Australian bank as well, offer in Singapore dollar. So you can have a look in our feature bond to have more insight. So when you visit our website, this is how the bond fact sheet look like. Okay, let me show you from this example. When you go to this particular bond fact sheet, right, under the overview page, you are over the score, the bond, whether you want to buy full lot bond. Actually, you are able to buy full lot bond from our platform as well, which means the 250,000 one lot. That kind of full lot bond is available as well. That one you will need to reach to our bond dealer team and ask whether they have any available bond for the full lot bond or not. So you can score to the right for the Bond Express, information. So when you scroll to the right, the smaller lot, you will notice that the minimum investment, this one is under wholesale bond, minimum is 5,000. And then the year to maturity, we show you 3 years. And then the net yield, like I explained just now, we'll show you the net return that you will get per annum. And then what is the price? So this price actually is a fixed price already. Once you go log in, and then place the order, then you were able to lock in the net yield of 5.4% already. And then on the right hand side, we will showcase you the indicative cash flow when you buy the bond. Okay, you can change the amount. You can key in 100,000, you can key in 10,000, whatsoever amount. Then we will show you what is the total income that you will receive, or what is the payment and what is the yield. Then we will show you, normally the coupon payment, it will be paid, like for example, for this bond, it will be paid every 6 months. So meaning to say, when you buy this particular bond, on December 2023, you will receive this particular amount. And then June, you will receive this particular amount. Until maturity, then you will receive back the principal, which is the 10,000. And then when you click on information tab, then we will show you what is the issuer, Tan Chong Boto, and then what they are doing. And then all the bond information will be available here, included the bond credit rating. And then the next one, if you click on the fee, then we will let you know the fee that we charge under our platform. For corporate bond, for retail bond, we are charging 0.5%, minimum 8 ringgit 80 cents. Corporate bond, wholesale bond, 0.5%, minimum 35 ringgit. For Malaysia government bond, you are able to buy Malaysia government bond as low as 1,000 in retail bond. If you would like to buy the whole lot is available, but whole lot is actually, the lot will be smaller, not 5 million. You are able to buy the whole lot of 10,000 only for Malaysia government bond. That's specially offered under our platform. So the the processing fee will be lower compared to corporate bond. It's 0.1% for government bond, and for you are able to buy US Treasury notes as well in our platform. 0.1%, minimum USD 10 ringgit. And then for our platform, we do charge a platform fee. The platform fee will be 0.045, which come to 0.18% per annum. And then for government bond, we will be come to 0.08% per annum. But this one, actually, it will be paid upon, normally investor will be paid upon you receive the coupon payment. When the coupon payment issue, then the coupon payment will go into your cash account in our platform. And then from the coupon payment that issue, then from there we will deduct the platform fee. So I would like to close sorry, not close. I would like to summarize the bond masterclass today. Why invest in bond today? Because I have explained before, because currently the interest rate environment is very beneficial to the new bond investor right now. If you never invest in bond before, actually now could be the best time or right time for you to lock in higher return. Because if you compare to investment in FD, for example, investment in FD is not locked in, because when you lock in for FD, normally they will just lock in for 1 year. Means you lock in 1 year for 4% rate. But would you able to lock in 4% return for FD return for the next 5 years? I don't think so, because the FD return will follow the interest rate movement. Because from what I explained just now, and based on market condition, interest rate not going to stay as high as now forever. The interest rate policy will overturn when market go into recession. That's why in future, you are not able to lock in the return of such a high return anymore. Means like 5 or 6%, that kind of return with a very low risk. Meaning to say, if you invested in maybe a bank's bond, or maybe when you invested in insurance bonds, so very unlikely a local banks or local insurance company go bankrupt, because based on historical in the bond market is never happened before. In Malaysia, I'm talking about local bond in Malaysia. So actually the risk actually is quite mitigate, and then you are able, at the same time, you are able to lock in quite high return for longer term. Because if you're talking about FD will follow interest rate. If the interest rate from current 3.5% drop to 2.5 or 2.75, FD will follow interest rate drop as well. But if you lock in bond, lock in 5% or even just 4.5% bond today, your 4.5% will lock for until maturity date. So that's explain why you should buy bond today, why now is the right time to buy bond. And then that's at the same time, you will enjoy capital appreciation because you still remember, right? When when interest rate fall, bond price will go up. So let's build your consistent stream of cash flow by using bond tools today. Okay, before I end, I think a lot of people also want to understand how can we use the bond and how do we link the bond to our investment strategy. Normally, I would suggest retiree investor that going to retire, they can consider bond as the income stream to generate the monthly expenses for their retirement life. For example, what you can do by using bond is you just imagine, because normally for local bond, right? Local bond will pay out the coupon payment every 6 months. So very simple. If next time when after retirement, I still can use bond to generate the monthly income for me. How can I do so? I can just use 3 bonds to do so. These 3 bonds, I can pick one bond. The first bond, paying coupon rate in January and in July. Second bond, paying coupon in March and September. And then third one, paying in May and November. So by doing so, by buying 3 bonds, I'm able to get 6 coupon payment every year. And you need to remember that the coupon payment that the company pay actually is fixed. I already know how much I will receive. So you have a better planning on the income flow. So definitely you will know every 2 months, I will receive certain amount of money from the bonds every 2 months. So I can use this money to spend for my retirement life without worry other things. Because you just imagine if you put all the investment under equity fund or unit trust fund, the equity fund, the share market, or maybe the unit trust fund, they do not have this feature to give you a regular income every 2 months or every 3 months. So that, and then you know how much, because this is fixed income, you already pre-know, you can planning how much you will receive. You already know how much you will get every 2 months. So it's the bond actually for me will be a better tools for us to plan for our retirement life, because if you are able to pick a good bond, and then those bond actually is able to consistent give you the income flow, at the same time your capital is preserved. Meaning to say, because a lot of people when come to retirement, right, they have this concept that, okay, I already saved 1 million or 2 million. That's the time I can enjoy. So they do not put the whole 1 or 2 million under investment. They are using the capital to spend. So the capital, when you use your capital to spend, your capital will getting smaller and smaller, right? But if you put your capital under the bond investment, your capital still remain there. Your 3 million or 2 million whatsoever is still there. And you are just using the income that generate from the bond as the daily spending. So this is one of benefit that you can link back to your investment planning. And then the second thing is, I can teach you another trick for estate planning. Because normally for estate planning, right, a lot of people would think that, okay, I would like to inherit, let my son to get 500,000 or let my son to have 1 million. So how can I get my 1 million or 500,000? Normally we save, right? We save, we invest, And then until when it comes to retirement, when we gather the money, then we give the lump sum money to our kids. But actually, this is not a very smart way. What you can do by using the bond is actually you can just use 100,000. You can use 100,000 to give your kid 1 million as the estate planning. How can you do so? You can set aside 100,000 and put under a 5% bond. 5% bond, I think, is very easy to get. So every year you will get 5,000 income. You'll get 5,000 income flow, right? So you just use this 5,000 to buy 1 million insurance policy. Life insurance policy, 1 million. Definitely, anything happen to you, this 1 million will pay to your kids, right? So I think 5,000 is good enough for you to buy a 1 million life policy right now. It will depend on your age. I just give you a very simple example. So you just put 100,000 in the bond. Then the bond will generate the return for you. So at the same time, your 100,000 is still there. And then you just use the 5,000 generated by the bond to pay the insurance premium. And then at the end of the day, your 100,000 is there. And then anything happen to you, your kid will have 1 million as the estate planning. So this is another way for you to utilize the bond to fully utilize the consistent stream of cash flow from this bond feature to help you on your investment planning. I think, okay, I think that's the end of my presentation. So this is the dealing hotline and WhatsApp. So from this dealing hotline and WhatsApp, you are able to reach our bond dealer team. And then bond dealer team is the one that who is able to help you for your bond investment. So what you can do is actually you can scan the QR code of this Telegram or WhatsApp. So from here, actually our bond dealer team will also share you the latest information of the new bond that available in our platform. Because if you refer to our website, right, most of the time actually the bond investment actually is quite hot nowadays. So a lot of people will come in and out from our platform and buy the bond. So you will notice that the stock of bond actually it will drain out very fast. So that's why if you want to know the latest, maybe if the bond dealer is able to place a new bond under the Bond Express, actually they will announce under the Telegram or WhatsApp group. So you will get first-hand information from there. So, okay, I think we can go to Q&A. I think I overrun quite a lot. So let me have a drink. So I will skip the chat box, and then I will concentrate on the Q&A. Okay, let me go for the first one. Okay, how to create passive income with bond strategy. I think this one I just explained at my last slide. So I will skip this one. Okay, hold to maturity or hold to call? Which to see? Okay, for hold to maturity or hold to call, okay, under our platform, right, when you go into the bond fact sheet, in the bond fact sheet itself, the yield that we show you, it will be either the yield to maturity, means the net return, net average return to maturity, or if the bond is perpetual bond, means the bond got an earlier call date. So the calculation that we set means with the calculation, the return that we calculate for you, the net year return, it will follow the net year to next call, means not the maturity one, means under the reset date. So you are able to see this information from our website. Let me show you. So you are able to see over here. So for this bond, right, actually we show you the net year to maturity. So if the bond is perpetual bond, we'll show you the net year to next call. So hope I answer this question. Okay, and then next question. What is the difference between Sharia versus normal bond in terms of return and risk? Okay, actually for the bond itself, right, the risk for Sharia compliant bond means normally we call it sukuk bond, and normal bond actually is the same. And then what is the difference? The difference will be normally sukuk will offer higher rate in the market lah, normally lah. But the rate given actually is just a little bit only. Okay, I see there's one client asked about pro and con of bond versus bond fund. Okay, the bond and bond fund, the difference between these two instruments is bond will give you the income stream because you will definitely know what is the income stream that you will get. But for bond fund, because you are invest in a unit trust fund, the distribution of the income stream actually it will depend on fund manager. Meaning to say you won't have a guaranteed income stream when you invest in bond fund because not necessarily the fund manager will pay all the income, all the coupon that they receive because the fund manager, they can reinvest the coupon payment and buy other bond paper and help you to generate higher return. So basically the difference of these two is one have the income stream, the fixed income stream, the other one do not have fixed income stream. So actually it will depend on your objective when you select the instrument. Of course, if you're talking about diversification wise, right, bond fund will be better because bond fund, the fund manager will invest in various kind of bonds. It will invest in maybe 40 bond, 20 bond, or 30 bonds. Means there will be a diversification over there when it comes to bond fund investment. So it will depend on your objective. If your objective is for the retirements, generate the kind of the monthly expenses, then the best tools will be bond because bond they have the feature to provide you the regular income. Okay, please explain loss absorption feature of a bond. Why there is such a need? I think I already explained just now for the loss absorption. And actually, this loss absorption only applicable for bank bonds, especially this loss absorption feature only applicable for the COCO bond. I already explained what is COCO bond before lah. So there's a need because after the financial crisis, because a lot of banks, they do not have a buffer, capital buffer. So anything hit the bank will be bankrupt already. But normally bank actually they are too big to fail. So that's why after 2008, the global financial crisis, those bankers actually they think of those regulators, I would say, actually they think of this AT1 bond to act as the buffer. If anything hit the bank, actually this particular buffer take off, then the bank can continue still survive. So that's why there is a need of the AT1 bond in inside the bank, bank capital instruments. So that's why when we invest in bank bond, right, we have to identify whether this bond is AT1 bond or is the second tier bond. Normally second tier bond, although they have loss absorption feature as well, but actually they are higher tier than the AT1. So meaning to say AT1 will be kena first, then only the second one will be until the tier two bond. So when invest in bond, invest in bank bond, if you are not too sure, actually you can check with us now. You can check with FSMOne. Okay, next question. If I were to invest in bond through FSMOne, will ownership of the bond be with FSMOne or me? Okay, if you invest the bond with FSMOne, actually it will be go through nominee system. So meaning to say the ownership of the bond is still with our company under the nominee, under the trustee. The bond will hold under trustee and then instead of you itself. So actually the arrangement will be same as when you invest in unit trust or you invest in stock investment. Actually, it will be applicable the same because we are under the platform operator, we were using nominee system, which is the trustee system, in order to hold the investment on behalf of investor. But let's assure that the trustee that we set under the nominee structure, right? The trustee actually it will be separate from the company asset. Meaning to say anything happen to FSMOne is if one day IFAS bankrupt or IFAS decide not to doing business in Malaysia, you close down Malaysia operation, your investment, your bond investment in trustee or your stock investment or even your unit trust investment in trustee is separate from company, is transferable. You are able to transfer to other investment bank or other fund house or other banks or other platform to continue your investment. Hope I understand. Hope I answer your question. And then next question, is the price of bond only reflecting the market interest rate right now? Or also what the rate are expected to be in future? Okay, is the price of bond only reflected the market interest rate? Okay, the price of bond actually it will there's two things will affect the bond price. First thing first will be the interest rate movement. The interest rate movement, and then second thing will be the credit rating, creditworthy of the company. So meaning to say if the company maybe there's some negative news on the company, it will also affect the bond price because normally people will sell off. So when people sell off, meaning to say your bond price will drop. So this is the two things normally will affect the bond price. But bond price actually will not fluctuate as much or that volatile compared to equity market. Because on equity market, you can see the share price from 10 ringgit can go up to 20 ringgit and go down 15, then go up to 30 ringgit again. But for bond price, actually quite stable. It will fluctuate around, you see, 100.19. It will fluctuate around there, 100, 101, 102. They will fluctuate around there. They won't fluctuate a lot unless the very extreme example that I show you all just now, unless the bond actually they have very long tenor and then they have very low interest rate risk, they have very low coupon rate, then actually the magnitude of drop or the volatility of the bond price will be higher if the interest rate move. Okay, next I will answer William's question. Why Bond Express has high rate? Is it because it is less liquid than full lot bond? Okay, why Bond Express has high rate? Okay, the rate under Bond Express, right? I think you means the price, the pricing. If you compare the pricing if you toggle here, Bond Express versus the full lot bond. Bond Express actually is the live price that we provide to investor. But for the bond full lot, the pricing in the bond full lot actually is not fixed. We are just capture the rate from Bloomberg. Like I explained previously, because for bond market, there's no exchange in the market. So it's very hard for us to refer, or it's very hard for us to pick which price should we refer in the market, because there's no exchange, there's no standard pricing to follow. So what we do is our company will just follow Bloomberg. Bloomberg terminal feed us what is the price right now. We will just feature it in our website for the full lot bonds, but not necessarily you will get that kind of pricing, because that kind of pricing, the pricing actually always depend on the demand and supply in the market. So for full lot bond, how bond dealer will deal for you is actually, okay, for example, if you want to buy a Tanjong full lot bond, so you place an order for the full lot bond, 250,000. What our bond dealer will do is, our bond dealer will contact, because it's the over the counter, it's the OTC market. So our bond dealer will contact all the banker. They will contact Maybank, they will contact CIMB, they will contact whatever investment bank that we have, the contact that we have, we'll call. Do you have Tanjong? I need 250. So they will ask around and get the lowest price. Maybe the lower price is 100.19, which is the issue price. There's no markup from the market. So if we are able to get 100.19, then our bond dealer team will call back investor. I I get 119. Do you want 250 or not? So, or maybe I get 100.5. Do you okay with this price or not? So we will need to source in the market and see what is the price that where the seller willing to offer. So this is how the whole lot bond working. Hope I answer your question. And then, okay, next question. Why there's a difference between price between bond express and full lot? That see years, which is very reflected the bonds. I think this one I explained in my previous question already. Okay, I flag off. Next question. Please provide name of bond which have default in the local bond market. How many of these bonds were investment grade? Okay, based on what I know, the investment grade bond that default before means those A and above investment grade bond that default before, I think very less. We only have one or two bond only. But I could not answer you right away right now. If I'm not mistaken, I'm not very sure. If I'm not mistaken, I think it's Perwaja, the steel factory that default before. I think that will be the one. Maybe for this one, maybe I will need to double check with bond team, and then we can get back to you. But for all the history in the market, for the A and above that kind of company, right? Actually, very unlikely got default cases. Okay, default. Okay, let me see. Deferred interest rate. Deferred interest rate means I'm not too sure deferred interest rate you'll capture from there. If I'm not mistaken, I think it's one of the feature of the how to say one of the feature of the bond. Okay, for deferred interest rate actually means I think it's deferred coupon payment, if I'm not mistaken. So if the bond has this deferred feature, means actually the bond issuer, the company itself, they can decide to defer the coupon payment. Meaning to say, because the company will need to pay you the coupon every 6 months. If they have this clause under their bond offering, means the company can decide to defer the coupon payment. So actually under the defer coupon payment there, actually the company can defer, means they do not want to pay you for this month, this 6 months. They defer to next time. So they defer to next time, then only they sekali goes pay you, or some term and condition, they can just ignore. They just skip this round and then pay you the next round. So some of the bond will have this feature, but you need to remember that when the company, none of the company will like to utilize the deferred interest rate feature, because once they utilize the deferred interest rate feature, meaning to say they have difficulty to pay back the loan already, it will directly affect the credit risk or the credit rating of the company. So meaning to say this will be the last resort for the company to utilize when come to default. Meaning to say, but even the company have this particular feature, right? It will be the same applicable for normal bond. If the company is not able to pay back, they will also defer the interest rate. Means they're not able to pay back you the coupon payment. They will also stop making payment. Actually, it will be the same. It's just that they will have this feature under the bond feature only. But not necessarily the bond have this feature. They can suka don't pay you the interest. They cannot, because it will affect the credit rating of the company. Okay, I have another question. Is it means as long as I don't plan to sell off the bond before the maturity date, then I won't need to worry about the up and down of the graph? Is it? Yes, basically, if you plan to hold the bond to maturity, basically it will help you to mitigate the interest rate risk already. Meaning to say the bond price, no matter they go up or down, it doesn't matter to you. You just continue to collect your coupon payment. For example, the bond give you 5% coupon payment. You will continue to receive 5% every year until the maturity date. The company pay back you 100. Pay back you your principal. That's all. Very simple. So in between, the bond fluctuation doesn't have any meaning to you. The bond fluctuation only have meaning for trader, because for bond, when investor invest in bond, right? Got one is saver. Saver means I just buy and hold to maturity. Another one will be trader, meaning to say I look at the interest rate environment and then I plan my investment accordingly. And then I plan to sell off when I get certain capital appreciation. Maybe in 2 years' time, I get a 5% or 6% capital appreciation, while at the same time I receive the coupon payment, then good enough for me, then I sell off my bond. So there's different investment style, so it will depend on the investor. But yes, if you plan to hold to maturity, then you do not worry about the bond price. Okay, what about the case of SERBA dynamic bond? How does one mitigate or reduce such risk? Okay, there's one SERBA dynamic bond also being default because of course, because for the stock, for the SERBA dynamic stock itself, actually is the stock already delisted, and then the company is under liquidation. So for this kind of company, right, it's very hard for us to identify the risk, I would say, because what happened to this company is the management actually they alter, or the management actually they manipulate the financial report. So when the bond research team, normally we research the company through the financial report. So if the financial report itself is already manipulated by the management, then actually it's very hard for us to identify the risk, because the whole thing actually is not the true thing. It's not valid. So that's why for the case of SERBA dynamic, actually I can say actually it's very hard to identify, because for such case, actually they manipulate the financial report. Okay, the perpetual bond are not same as COCO bond, right? Yes, perpetual bond is perpetual bond. COCO bond is COCO bond. COCO bond only applicable for banks. For banks, perpetual bond, we will call it COCO bond. But for normal company, means the normal corporate, like other than banks, the corporate, the company, they also can issue perpetual bond. So, but the perpetual bond that issued by company, normal company other than bank, they won't have loss absorption feature, because that particular feature only applicable for bank only. So let me see another question. Perpetual bond for non-bank, there are no loss absorption feature, correct? And is there anything happen we need to look up for? Actually, no. Like I explained in the previous question, perpetual bond for non-bank paper, there will be no loss absorption feature. Okay, I think I have a few questions. I think I cannot finish everything. I think it's overrun for 15 minutes already. I will continue to go for another maybe 3 or 5 questions before I close the night. So if you have any further question, what you can do is actually you can email to us. I think my colleague Yvonne can help to send the invest help email in the chat box. And then what you all can do is you can email your question to us, and then we can reply you accordingly. Okay, let me take last 3 questions. Based on the seniority, should I not avoid equity level is being the lowest, or how do I know that it is safe? Which seniority level is usually available? Okay, I think for this, right, you should not focus and pick the bond that have higher seniority. This is not the case for you to select a bond, because when we invest in bond, right, most importantly, we would like to avoid the default case. Meaning to say, if you're able to avoid the default company, it doesn't matter whether you invest under which seniority, because the company won't default. So the seniority doesn't carry any meaning to you. So that's why the most important thing is we need to look carefully on the company that we're going to borrow the money to them? Is it the company is good company? And then whether the company is able to pay back me the money within these 3 years or 5 years or not. So if you have the confidence that the company is able to pay back you the money, for example, you borrow money to Tanjong. So Tanjong is selling car, and then they are the quite large car distributor in the market. If you think they are able to generate enough return, pay back the coupon payment, and at the end of the maturity date, they are able to pay back you the payment, they are able to pay back you the principal, then actually it's good enough. You do not need to look at the seniority and all that. The seniority, you only look at the bank bonds, because bank bonds got this special feature on the COCO bond. So that's why you, actually before the Credit Suisse scenario, a lot of people doesn't aware about this COCO bond. Even we ourselves, we also doesn't matter, because normally bank is hardly go into bankrupt, right? But after the Credit Suisse incident, then actually we know that, oh, bank actually they have 81 bond, means those COCO bond, and then they also have tier 2 bond, and then they also have secured bond. So when you invest in bank bond, then we will need to look at the seniority already, whether, okay, if we think the return that giving by 81 bond, like for example, the Barclays Bank, they're giving 8.3%. If this 8.3% justify the risk that I take, I'm okay to invest in this bond, because I need to justify that Barclays Bank, whether Barclays Bank will go into bankrupt or not, like Credit Suisse. Or maybe if I change the name, HSBC or Standard Chartered, if the 81 bond of HSBC Bank or Standard Chartered Bank worth to invest or not, I think it's okay, because maybe they have lesser risk to be default. Then the return that paid by the 81 bond actually is mitigate the risk that I take. So actually it will depend. It will depend on the risk appetite of investor as well. Okay, second last question. In Malaysia, Bank Negara has announced that they will not follow the Credit Suisse method. Our bank perpetual will not go for equity holder first before coming for perpetual bond holder, correct? Actually, yes. For Credit Suisse, actually, when you refer to the seniority, right? Equity holder will be the last one. If the bank going to liquidation or default, actually equity holder should not receive anything. Then only come to the 81 bond. But the practice of Credit Suisse government actually is Credit Suisse Swiss government, actually they organize this merging. So for this Credit Suisse method, actually is very unusual settlement method, because the seniority, when it comes to investment world, the seniority actually is wrong already. So actually you can see from a lot of news, the Bank Negara Malaysia governor, even the US, UK, and Europe, the federal governor, they step up and tell everyone, all investors, don't worry, we won't follow the Swiss government, because this arrangement actually is unusual. That's why you see currently Swiss government actually is being sued by a lot of investors. They are being sued by Singapore, I think Singapore government or Singapore investor, and a lot of investors actually they are finding the way to sue them because of this. So this is unusual. Okay, let me see. Okay, last question. Is the yield calculated by days? If I were to subscribe to the bond close to maturity, let's say buy in March, bond matured in June. Okay, the yield, right? Okay, the yield that show actually is a very good question. The net yield to maturity showing in our bond fact sheet actually is the annualized return. If you refer to the year to maturity, right, if it's more than 1 year, meaning to say if you see more than 1 year, 2 year, 3 year, or 5 year, the yield is correct. 5.4% per annum is correct. It's the net return that you will receive. But if the year to maturity is less than 1 year, meaning to say 6 months or 3 months, the rate here actually is the prorated, is an annualized rate, meaning to say, okay, if you see the year to maturity actually is just six months, if you still see 5.4%, doesn't mean that 6 months you will earn the 5.4%. No, wrong. Because this is annualized return. You will need to divide. If there's 6 months, you will need to divide 12 times 6. Then you will get the actual return. Because this is annualized to 1 year. So for the bond that less than 1 year, you will need to recalculate. Actually, the logic or the rationale, it will be same as the FD rate. Because normally when bank offer you FD rate, they will tell you, we offer you 5% FD rate offer, but they only offer you 3 months only. So doesn't mean that 3 months you earn 5%, right? You have to divide 12 times 3. So the same thing happened to here. For the bond less than 1 year, you have to calculate, you have prorated the return. And then one thing to note is if the bond actually is close to maturity already, actually it's not worth for you to invest anymore, because normally when close to maturity, the price it will be close to 100 already. And then at the same time, you will lose out because you will still need to pay the processing fee of 0.5%. And this 0.5% is doesn't, if this 0.5% that you pay, it will not justify for you to buy a 3 months going to maturity bond. So that's why when we buy into bond, we want to check the year to maturity as well to plan for your investment. So I think that's all that I have today. So thank you everyone. Thanks for your time. And then so sorry for the long overrun. And I hope you can get some insight back tonight. And then if you have any further question, feel free to contact us, and also feel free to chat with us. So if we are able to help you for your bond investment journey. Thank you very much. Thank you.